Imagine an investment strategy that buys itself more shares automatically, actually gets you a discount just for doing absolutely nothing, and, well, here is the absolute best part. It actually works harder for you when the market crashes than when it's booming. I know, it sounds exactly like a late-night infomercial pitch, doesn't it? But it isn't. It is a very real, decades-old wealth-building strategy, and honestly, it's wild how many beginner investors have never even touched it.
So I really want you to ask yourself a simple question here. What if your investments just bought themselves? Think about how much emotion, how much second guessing, and how much of that market timing anxiety you could completely remove from the equation, all by just having an automated tool quietly doing the heavy lifting in the background. Well, that is exactly what we're breaking down in today's explainer.
Here's our roadmap for today. First, what is a DRIP? 2. Issuer versus broker DRIPs. 3. The compounding snowball effect. 4. Hidden complexities and taxes. 5. When absolutely not to DRIP. And finally, 6. Mergers and splits. Let's get right into it. All right, Section 1. What is a DRIP? The basic mechanics.
So DRIP stands for Dividend Reinvestment Plan, and the foundational concept here is pretty straightforward. When you own a dividend-paying stock, an ETF or a mutual fund, they periodically pay you a dividend, right? Usually, this dividend just gets deposited as cash, and it sits there. It sits idly in your brokerage account, doing absolutely nothing until you manually log in and decide what to do with it. A DRIP fundamentally flips that default behavior on its head.
What's truly incredible here is just the sheer efficiency of this three-step flow. Step 1, you earn that cash dividend. Step 2, instead of receiving a manual payout that just collects virtual dust in your account, the plan intercepts it. And then Step 3, it automatically uses that exact cash to buy you more shares of the very same investment. There are no manual trades you have to go execute, and in most cases, absolutely zero extra trading fees. Your cash doesn't wait around. It goes straight back to work.
Moving on to Section 2. Issuer versus broker DRIPs. Choosing your path.
Okay, so you basically have two main paths to set this up. Issuer DRIPs are set up directly with the company itself. We're talking about massive corporations here. Think Johnson & Johnson or Coca-Cola. The huge advantage to this route, you often get a 1 to 5% discount on the share price and you pay literally zero fees. The catch is you do have to manage a completely separate account. On the flip side, we have broker DRIPs. These run through your standard brokerage. Now, you miss out on that sweet share price discount, but you gain a massive amount of convenience. You can manage all your investments in one single place and simply toggle the DRIP on or off with just one click. So really, it comes down to convenience versus cost savings. That is your core trade-off.
Section 3. The compounding snowball effect. Dollar cost averaging. Now, to show you how DRIP compounding actually works in practice, I want to introduce a recurring character for this explainer. Meet our standard, hypothetical $100 dividend payout. Just imagine this $100 has just been paid out to you, and because you have your DRIP turned on, it is sitting there quietly waiting to be automatically reinvested.
And this, right here, perfectly illustrates the real magic of this strategy. Let's look at the math. If your stock is currently trading at $50 a share, your automatic $100 dividend buys you exactly 2 new shares. Simple enough, right? But what happens if the market has a terrible quarter and the price drops to $25 a share? That exact same $100 dividend now automatically buys you 4 shares. I mean, really think about that counterintuitive reality for a second. When the market crashes, your automated dividend actually works twice as hard to buy you double the shares at a steep discount. The absolute most crucial takeaway here is that the math does the timing for you. Your dividend automatically buys more shares when prices are cheap and fewer shares when prices are expensive. Fast forward over a few decades, and this creates a massive compounding snowball effect. Those extra shares you bought at a discount, well, they generate their own dividends, which then turn around and buy even more shares. It completely removes the anxiety of trying to perfectly time the market. Honestly, it's slow, it is super boring, and that is exactly why it is so incredibly effective at building wealth over time.
Let's look at Section 4, Hidden Complexities and Taxes, because it's not quite a free lunch.
Okay, we need to talk about the friction. First off, because your dividend payout is rarely going to divide perfectly evenly into whole share prices, you are definitely going to end up owning fractional shares. Now, brokerages usually track this automatically, which is great, but it does make your cost basis much more complex to figure out when tax season rolls around. It's just a reality. Second, if you chose that issuer DRIP we talked about earlier to get that nice share discount, just be aware that selling can actually be slower.
If you have a sudden emergency and you need to liquidate quickly, going direct through the company can add some unwanted friction compared to just tapping sell on your broker app.
And look, I absolutely cannot emphasize this quote enough. Reinvested does not mean untaxed. Even though that $100 we talked about was automatically reinvested and you literally never touched the physical cash, the tax authorities, yeah, they do not care. They still treat that reinvested dividend as taxable income in the exact year it was paid out to you. So skipping the manual cash payout does not mean you get to skip the tax bill. Keep that in mind.
Section 5. When not to drip. Who should avoid it? Look, drips really shine for long-term, completely hands-off investors whose main goal is just sheer growth. But if you are a retiree or maybe someone who really relies on those dividend payouts to pay for groceries, cover your mortgage, or just fund your daily lifestyle, a drip is a pretty terrible idea. Automatically locking your cash back into shares completely defeats the entire purpose of holding an income-generating asset in the first place. Bottom line, if you need the income today to live on, leave the drip turned off.
There's also another subtle danger here, and that is diversification risk. If you just blindly funnel all your dividends back into the exact same 1 or 2 companies for 10, maybe 20 years, your portfolio can quietly become dangerously concentrated. You could literally wake up one day and realize a massive percentage of your entire net worth is tied up in a single stock, completely throwing your risk management out the window. So you have to keep an eye on it.
Finally, Section 6. Mergers and splits. Corporate actions.
So what actually happens if your drip company gets bought out? Well, in an acquisition, one of 3 automated things is going to happen. Either your plan transfers to the acquiring company's drip, your shares automatically convert into the new stock, or they just terminate the drip entirely and pay you out in cash. Now, what about stock splits? Those are way simpler. Your reinvestment plan just carries over completely seamlessly. You'll just keep right on buying shares automatically, just at the new split-adjusted price. Easy as that.
So, as we wrap this up, I want to leave you with this final thought to reflect on. If you don't need the cash today, is your money working as hard as it possibly could be? A drip is definitely not going to make you rich overnight, but it flawlessly removes the emotion and the guesswork from investing. It puts every single dividend straight back to work year after year, dip after market dip. It is boring, but man, it is highly effective. So, what do you think? Is this automated compounding tool something that should be quietly working in the background of your portfolio? Thanks for joining me on this explainer, and I'll catch you on the next one.